Good stuff. Well, first of all, again, obviously, thank you, TradeThirsty. Also, good stuff there by Josh before, also a good friend of mine. But that's enough of the love fest here. Let's get down to business and talk about a real trade. Now, what I want to say before we get started on this trade idea, what you're gonna see here today is a trade idea, and it's not just an idea; it's a trade that I certainly have on, and a lot of people that I deal with are in the institutional space. So these are either clients of private banking institutions, so private clients. They might be hedge funds or institutional investors of other types. And a lot of these people have this trade on that I'm about to show you, the ones I talk to. So this is not something I'm just kind of coming up here, sitting on the sofa in my underwear. Sorry for that visual, but this is a real thing. This is a trade that I've done before in my career. I've done this now for 21 years at this business. And so, working at various institutions from JP Morgan to family offices and things like that. And so this is really good stuff. And at least for nothing else, at least good perspective. I will tell you what's important to understand about this trade. This is what's a so-called macro trade. It's a trend following trade. This is not the kind of trade you have to freak out over every single day like a lot of other stuff out there. This is a trend following trade, and I think you guys will see what this is all about here very shortly. Before we get started, one last thing, and I need you to understand that I'm not here to fear monger. I think everyone that follows me knows this. Sal certainly knows this. This is some data that I've gathered by doing research. I basically among all the trading and investing and everything that we do for clients. Obviously, research is the primary concern, so we can actually do our investments and trades. But this is data that I've gathered. I'm not here to fearmonger. I'm not asking everyone to agree with me necessarily in this trade, but I'm going to lay out the case for it, and I think a lot of you will probably see why this makes a lot of sense. So, what are we talking about here? Well, the global economic growth story is continuing to slow. It's one of those situations that I think a lot of people are kind of lagging to wake up because the S&P 500 continues to push higher, but we have already seen a lot of signs over the past 12 to 18 months of cross-asset volatility picking up. Bond yields are collapsing. We'll get more to that in a little bit, but cross-asset volatility, anything from currency volatility to bond volatility, even volatility in various things like gold and even equities have been spiking more and more frequently over the past 18 months. And so what we're going to do is we're going to go through a couple of things. So this presentation is very structured because I need to make sure you guys are following along with me. So there's every slide here is a reason why it has a certain sequence, because it's important so you guys can understand the trade. First of all, we're going to go through and give you some hard data. This is on weakening economic backdrop. Then we're going to go look at charts. I'm going to show you guys basically the weakening economic data in charts, so you guys can see that I'm not just making this up. Thirdly, and probably most importantly, we're going to look at the bond market, what's telling us. And for some of you guys, you might be thinking, well, I don't care about the bond market. As someone who's been a trader and a professional investor for 21 years, I can tell you the bond market is the most important thing to understand. Then we're going to look at the profit opportunity, of course. That's ultimately really the most important thing. And yeah, I guess that's what we're going to do here together. So let's start up with the situation. What's the situation? Where are we at? What's going on here? Bigger picture. I call this the WWH, the what, why, and how. And so the stock market has essentially been trading in a rather choppy and volatile fashion, all else being equal, since about early 2018. Yes, we continue to see, push to the upper end of the range here when it comes to the S&P 500, but we'll look at that here shortly, why that's a bit of an anomaly. And investors underneath the surface, and I'm not talking about the average retail trader at home, I'm talking about sort of your institutional investors that are putting a lot of money to work. They have increasingly been getting more frustrated. This is the group of investors that I speak to a lot on a daily basis. In terms of the why, well, why is this happening? Global economic growth continues to slow. It's not a straight line. These kind of things take time to play out. Trade war uncertainty is still kind of out there. Bond markets are rallying sharply. So these are all, among other things, are all signs why people are getting more concerned. And thirdly, how do we make money with this? What's the how? We'll address this in much more detail here in a minute. But really, there's a couple things one could do. One could de-risk, so going to more defensively positioned, defensively oriented positions in the equity portfolio, if that's what you do. I think one could marginally, try to even short the market if you have a time horizon that goes beyond a week or so. Or you could do what I'm going to show you guys here today. What I'm going to make the case for is the most successful hedge fund trades that I've ever seen, period, over the past 21 years of my existence as a professional trader and investor. So let's start off with some economic data. The situation with USA data. Let's start off on the home front. You can see here, this is data print from a few weeks ago. The ISM manufacturing data came in at 49.1, and you can see it's been slowing now for some time. So the trend here in manufacturing slowdown is not new. It's been going on for some time, but it's now dipped below 50. And this in isolation wouldn't be such an alarming thing. It's just all the other things that I'm about to show you here that make this a bit more concerning. In Europe, again, we're kind of trying to show you all sorts of different data, so you can see that I'm not trying to cherry pick my data points. Over in Europe, Germany essentially is going into recession, almost definitely into some sort of recession. You can read what it says here, but August 14th, a second quarter 2019 GDP was printed at negative 0.1. So that's not exactly all rainbows and puppy dogs there. Not good data, and again, it continues to worsen. We again got worse data this week, so this is a trend that continues and has been intact now for some time. Moving over to Asia, here it's easiest to look at China just because it's the biggest player there. Again, not trying to cherry pick too much, but you can see, for example, China's industrial production. The trend there is pretty clear. China's monthly retail sales. Again, I'm trying to show you a diverse set of data. We could go and show you one set of data and make a big deal, but I want to show you different things. GDP, China, I think it was almost exactly 1 week ago. Well, I think a week and a day ago, when China printed a 6% GDP, which is the slowest in I think 30 years. And the IMF, if they're any good at forecasting, they're actually forecasting a below 6% GDP print for in 2020. So that's a little bit of a background on economic data. Again, I'm not here to fearmonger. I'm not here to be a perma bear. Not at all. For those of you guys that know me, I'm all about looking at data in a neutral capacity and being able to make market both ways. But here, this is really lining up to be quite a one-sided story. So we've looked at some economic data, and those were mostly just a couple of some data points without much charts to it. But what we're going to do right now together is we're going to go through and look at all of this through the lens of a bunch of charts on different asset classes. We're going to look at equity charts, so charts of stocks. We're going to look at charts of commodities. We're going to look at charts of currencies. We're going to look at charts of bonds, and even more than that. Why such a diverse set of data? I'm not here to confuse you. I'm trying to show you that the charts are telling us the same picture almost everywhere. And it's also important to understand when you look at a global economic landscape changing, it doesn't change on a day-over-day basis. So this is not about sitting in front of your screen and trying to day trade some sort of a penny stock. This is about the global it's almost like an oil tanker trying to change course, right? This takes time, but the signals are getting clearer and clearer here every week we go through. So let's take a look at some of these charts, and I think you guys are going to have a real aha moment as we start to go through some of these charts. So first of all, let's have a look at some global equity markets. For the most part, if you X out the S&P 500 and maybe one or two other indices, we continue to see global equity markets essentially trot sideways to marginally lower if you look at this through the lens of the past year and a half, so stretching back to the early 2018 highs. Here what I did is I plotted the New York Stock Exchange composite as well as the German DAX. And again, we've obviously seen a bit of a recent uptick in equities again, but the bigger picture hasn't really changed at all. The point here is why the New York Stock Exchange composite versus the S&P, which I'll show you the S&P here in just a minute. The New York Stock Exchange composite has something like 2,000 as stocks and things like that in there, so it's a much more diverse index, if you will, than say the S&P 500. And so that is a more fair comparison to kind of give us an idea of the global landscape here. And you can see, again, we continue to kind of print these lower highs, or at least sideways range at best. If you look at the S&P 500, now the S&P 500 is a bit of an anomaly. First of all, the S&P has is very heavy weighted tech. Depending on how you tilt it, somewhere between 20 and almost 30% of the S&P is tech, and tech is still basically in secular growth mode, and so that's why the S&P is a bit of an anomaly. You also have a lot of chart chasers basically trying to buy the dip. A lot of algorithms that we track out there are doing the same thing. So there's a bit of a tilt at how the S&P looks versus other things. Nonetheless, even here, if you want to look at it purely technically, and we'll go deeper in a moment, you can see we have this, what I've been showing my clients for the better part of the past 5 months, this sort of, we call it a megaphone pattern. And it sounds ridiculous, I know, but it's a charting pattern that makes a lot of sense through the lens of technical analysis. Basically, we have been trading in a range, and there's plenty of downside here, and really very little upside to the lens of, let's say the next few quarters or so in terms of duration, the way we look at the market here. So that's the S&P, and I know a lot of people are really ultra focused on the S&P, particularly US-based investors, but I will warn you that the S&P doesn't tell you the whole picture. It tells you a picture, but it really only paints a corner of the picture, and really what you need to see is the whole picture, right? So this is a bigger picture chart. It's not about, was this chart printed yesterday or tomorrow? This is a big picture chart, which is why it goes back 10 years, right? The bigger picture hasn't changed over the past few days or the past couple of months. Switching gears to a little bit different, what we're going to look at here is share buybacks. And I think share buybacks, if I look at it through the lens of my insight, my data that I get on a weekly basis, is at a major risk of slowing down rather dramatically. You can see the uptick in share buybacks over the past decade, and once they start slowing, this really is a major bid underneath the market that starts to disappear. In fact, if you look at share buybacks, there's a couple of statistics I can give you. Share buybacks are the S&P 500 would be 20% lower right here, right now, without any deterioration, all else being equal, if it wasn't for share buybacks, right? So just that alone would be 20% lower, which a lot of people would be quite shocked by that. So just kind of keep that in mind. Obviously, share buybacks are a reality, and they have been a reality, but I'm just trying to give you a statistic. If it wasn't for share buybacks, the S&P would be 20% lower. In fact, I actually think would be even lower than that, probably like 30% less. To kind of juxtapose this, stocks with share buybacks versus those without share buybacks, you can see there's a massive gap in outperformance on stocks with share buybacks. That's the white line versus the S&P 500 in and of itself, right? So again, there's a big difference there. So you can see how big that would be. So basically, the S&P is up like 300+%, a little bit more since 2009. If you look at it this way, versus stocks with buybacks, close to 500%. So that's a huge margin there. And if these share buybacks start to slow, and I definitely think they will very soon, then that's a natural bid that's going to disappear in the market. I'm switching gears to something totally different. This is the US dollar. US dollar is very important. And the US dollar, even though we've seen a little bit of weakness over the past a few weeks, it still is bullishly tilted. We'll talk about more why that is here shortly, but basically a strong US dollar here is not something that's very good for the global economy nor the US economy. It's not something that the US government is necessarily interested in either at this point. So, but it continues to happen, and there's a reason why. So this is important to kind of keep a very close eye on. The US dollar is a really important tell. Looking at something totally different again here, we're looking at commodities. I don't know how many people in here look at commodities, but commodities, again, this is a big picture chart. This is not about looking at this chart on a minute by minute or day by day basis. This is a big picture chart. You can see it traces back 10 years. And I think the trend is pretty clear. There are going to be gyrations here and there, but I think commodities hanging on a cliff. And I want you to think about this very simply. If commodities look like this, does that really mean that the global economy is rip-roaring and doing wonderfully well? I'm not saying we're about to have a massively catastrophic depression in the market. That's not the point. But if you really think about it, just put all else aside, put all the wonderful rallies that you've seen over the past few days in Teslas and whatever aside, and just look at this chart and think about it. If everything was so awesome, why are global commodities at the point where they are right now? Another thing is gold, and I know a lot of people look at gold. Who looks at gold in here? Anyone interested in gold? Interesting chart here. So the gold chart is the one in blue, whereas the yellow chart, I know it's not as clearly visible. The yellow chart is the US dollar. And what's important here and very notable, and again, to be clear, I'm not a gold bug. I'm just trying to show you some stuff here that I think is quite interesting. Gold is, in my opinion, in a new secular bull market. And if it was, and gold, by the way, is up versus all major currencies this year. That, to me, tells me that there's actually underlying real demand in gold, and it's not just some sort of a hedge against, basically potentially a weakening dollar, right? And what's really interesting about this, and this is really, really key, gold has been rallying this year along with the US dollar. This is a very rare occurrence. Usually when gold rises a little bit, it's on average on a day-to-day, week-over-week basis, it's kind of because of a weakening dollar. This year, both of these things have been pushing higher. So again, it underpins the real demand that we are seeing in gold, not just from institutionals, not just from individual investors, but also from central banks. A lot of central banks are definitely buying gold, and that's, again, a lot of the stuff that we look at on a week-over-week, month-over-month basis. So this is a real demand in gold, and it also tells us a little bit about the global situation going on. High yield bonds. I'm originally a credit guy and a fixed income person. That's how I started cutting my teeth in the investment banking world a long time ago. And high yield bonds are a major tell. So the credit market is really, really important to tell. Almost every single global recession to a global major slowdown to potentially even recession is usually triggered by some sort of a credit market problem, some credit market. So this is high yield bonds. This is basically bonds of less credit worthy corporations, if you will. Now, they haven't shown a lot of signs of cracking. In fact, they've continued to kind of push a little bit higher, but what's really important to understand here is that where these high yield bonds are right now. They've been trying to break higher for some time. I can tell you, as someone who's originally a credit default swap trader, the credit default swaps are starting to show cracks little by little. It's not a catastrophe, but that's a market that we're watching very closely. And I think high yield bonds are living on borrowed time. And again, I'm not here to paint doom and gloom. I'm not here to tell you that the global economy is about to collapse. I'm just trying to tell you that the exuberance we've been seeing year to date, quite frankly, except for a month here and there, I think is soon going to be tested with a real reality check, and these things will start to kind of start moving in the opposite direction. Again, something totally different, European banking stocks. Anyone in here look at European banking stocks? If you're not, you should. There's a couple of reasons why. We'll talk about that in a minute, but bonds, negative bond yields in Europe is a big deal. But again, European banking stocks. What does this chart tell you about European banking stocks? European banking institutions are not insignificant to the global economy. It's important to watch those. And again, this chart looks very much like the commodities chart before. Not a whole lot of correlation there, to be honest with you, but again, they do look quite interesting. And structural issues in the European banking sector, too many banks, basically still too regulated, negative interest rates, a lot of issues that I talk to a lot of the private bankers that I speak with on a daily basis. Again, not a good picture, and with that, coupled with basically European economy, particularly Germany, definitely slowing down. Not exactly an amazingly bullish picture to start loading up on your favorite high beta stock here at this point. Switching gears to, again, something totally different again, a couple of stocks a lot of you guys might be familiar with, Dollar General and Walmart. These are two very good performers this year in the US equity market, and you have to ask yourself, why is Dollar General having such a vertical move this year? Is it because everything is awesome and everyone's only buying at Whole Foods, or is it maybe because some people are anticipating that there might be something around the corner? I can tell you, I talk to one of the largest clued in investors every day in Europe and New York, and they have been buying Dollar General for basically all year for a specific reason. And a lot of people obviously agree with that because they're not the only ones buying that. Otherwise, the stock wouldn't have gone vertical. Walmart is a similar example, although Walmart is not the same kind of thing. But Dollar General, people will switch and unfortunately start buying groceries to some extent at Dollar General, to the extent they have groceries when things become dire. And so this is kind of one of the reasons why, in my opinion, we've seen a significant bid in those two stocks. Let me just really quickly pause for just a minute or 30 seconds or 15 seconds. Can you guys kind of see what we're getting to here? Give me a quick me if this is making sense with you so far. I'm not asking you to agree with me. I'm not asking you to I'm not fear mongering. I'm just trying to paint a picture that's kind of playing out across a very diverse set of global economics. And again, I'm not here to fear monger. This is not an Armageddon call, not at all. That's not my thing. But it's an interesting thing to see. So let's have a look at utility stocks. Does anyone know when utility stocks tend to outperform the broader equity markets? It's usually when, number one, interest rates are going lower. Number two, people think utility stocks are good dividend payers, right? And utility stocks, like the things that give you power at home, tend to be quite stable, not just because of the dividend, because you kind of need power. Even if you're in dire straits, you're probably still going to buy milk and pay your electricity bill. So that's one of the reasons why these utility stocks have been holding up well. And that's really kind of what's going on here. And again, I'm not making this up. This is not something that that's just made up with some Armageddon type of analysis. It's just what it is. And I thought these charts might give you guys some perspective. And I see a lot of you guys are finding that interesting, which is good. One more thing, and this one's a bit of a sidestep, but it's really, really interesting to see this. This is a chart of US equities versus European equities, or US stocks versus European stocks. And you can see this chart, if you look at it closely, this goes back to the 1950s. So this is not a chart that goes back a couple of years or a couple of months. This is a statistic back to basically the 50s. Now, what does this chart tell us? You can see, for the most part, the relationship between US stocks and European stocks has been roughly between 1 standard deviation above the mean and 1 standard deviation below the mean. What does that mean? I know that's maybe some stupid statistic to some of you, but it's interesting because what we're seeing right now is obviously an unprecedented outperformance by European equity markets, US equity markets. I don't think this is sustainable. However, this is not a call that I think US equities are going to collapse. But as you can see, there's a little bit of a mismatch. So just kind of think about this for what it's worth. And again, I hope this is something you guys find attractive. This is probably not a lot of charts you see otherwise in today's webinar sprint here today on this Saturday. So I thought this might be an interesting one to show you. So we've looked at a bunch of charts. We've given you statistics on the economic global picture. Again, that's no annotations by me, just data. And the next thing we're going to do, we look at the bond market. Does anyone in here follow the bond market? Type in yes or me if you look at the bond market. I'm not asking if that's all you do or you're like a PhD in bond markets, but the bond market is an important thing to do. So I would expect quite a few of you to follow that. So what we're going to go through here today is we're going to go through some bond market statistics that I think are unbelievably important. And first, we're going to just ask a simple question. Is an economic recession inevitable? And again, I'm going to say this for the 4th time today. I'm not here to paint doom and gloom. That's not my thing at all. I'm just going to show you some statistics. So basically, what tends to happen is that economic gravity is inevitable, right? So the economic cycle is real, and no central bank ultimately can bend economic gravity, meaning that it's really difficult for when global economies slow down meaningfully enough, and they do it in synchronized manner, which is more or less happening right now, it is basically impossible for central banks to come to rescue that quickly that the slowdown doesn't continue, at least to some extent, and potentially even go into recession. And by the way, slowdowns and recessions are totally normal. They're just a normal part of the cycle. Right, so this is really not. I know it's not fun to be in a recession. It's not fun to be in a slowdown, and I wish we wouldn't be, but it's actually for the economics, it's actually a really good thing because it kind of cleans the system again so that we can have another growth spurt, right? So that's really important. So what tends to happen is that risk kind of starts slowly, but then it happens all at once, and it takes a while for people to wake up. So I'll give you an example. When I was an investment banker at JP Morgan in 2007, we saw a lot of things happening underneath the surface that started to spell out a lot of pictures, a lot of risk, literally about a year before things really started to get ugly. And it took a year and a half even for things to really start to kick up. And I think we're seeing a similar reaction here. I'm not prophesizing that we can have a massive meltdown, a massive global depression, basically, which I think we had in 2008, 2009, but I do think the slowdown could accelerate, and I don't think a lot of people through the lens of the next 12 months are really situated for that. So what tends to happen is when things start to slow, and they have, the central banks do notice it, but the central banks tend to come in and lag behind this. So you'll see central banks doing basically like what the Fed is doing right now, calling these like mid-cycle adjustments. They say, oh, we're going to cut 25 basis points, but then they cut again and again and again because they're kind of behind the curve. And until they really start getting aggressive, a couple things happen in the interest rate market and the bond market, and that's exactly what we're going to talk about here right now. So if you guys have kind of drifted your attention span to toggling around on your phone, maybe you're at the coffee machine, maybe you're writing an email on a different screen, please come back and pay attention right now. This is unbelievably important, in my personal opinion, in terms of what's going on and what the opportunity is that we're trying to capture here with what's going on in the bond market. So basically, if you've been following the global economic data, you've probably noticed that there has been essentially a race to zero interest rates. The question we have to ask yourself is, why are global yields falling like that? There's a couple of reasons: slowing global economic growth, the surge in yield, safe haven search. There's even a lot of demographic reasons why this is happening. More people are retiring, more, populations are aging. So, but let's talk about this a little bit more and really understand where the opportunity lies in this. What I think, and a lot of my hedge fund clients are agreeing with me, that this is really one of the best trend following opportunities we've seen over the past decade. So, here is a chart that I made for you guys, a little bit of a timeline that looks at the yield, and I say yield, of the US 10-year Treasury notes, i.e. some people call it a bond, right? It's technically a note, but it's a 10-year Treasury note. So let me take you a bit of a journey over the past 10 years. So we had the peak of the housing bubble in June 2007. That's when I remember vividly sitting at my trading desk at JP Morgan. We saw a lot of things happening. High yield bond deals were failing left and right. But of course, the equity world was still rallying. People in the housing market and all different parts of it were still celebrating like it was 1999. Fast forward just a couple of years, and the US 10-year Treasury yield went from 5.3% down to 2% in January 2009. That was the depth of the stock market crash that we saw. Just to put this in perspective, guys, if you're new to the bond market, that is a ginormous move for bonds to go from 5.3% yield to 2%. Well, we then had a bit of a rally, but ultimately we continued to fall in yields. So by July 2016, the 10-year US Treasury yield was at 1.4%. Then things started to pick up again in terms of growth. The Fed went on a hiking spree from December 2015 into about a year ago. And so by October 2018, guys, almost exactly 1 year ago, 10-year yields were at 3.2%. And you guys can go out and check my Twitter feed. You can go out and check my YouTube feed. I made a big deal back then in October 2018, but I think 10-year Treasury yields are going to go lower. you wouldn't believe how many hate mails we got, how many people that unsubscribed and left because I thought that yields are going to go lower. Fast forward to September 2019, call it October 2019, yields are back at below 2%, somewhere within the 1.6 to 1.8% range is currently where the 10-year Treasury yield is at. Economic gravity kicked back in just as everyone expected, 3.2% yield 1 year ago to kick towards 4% plus. We've had literally the opposite happen. The Fed has gone from hawkish, i.e. wanting to hike rates, to dovish literally within a month. It was pathetic to see. This is not a personal attack on anyone at the Fed. It's just, kind of how all this is happening. So yeah, so that's kind of what the picture is. Again, I want to just take a quick second. Does this resonate with you guys so far? Can you guys see the trend? Because if you don't see it yet, I think the next few charts are going to make it very clear. Here is the yield on some Western European 10-year government bonds. Some of you guys might be asking, oh, why the hell do I care about European yields? Well, it matters. Trust me, it really matters. Here is France, Austria, Denmark, and the Netherlands. I know, you might be thinking that doesn't matter. Oh my God, does it matter? Basically, number one, you can see a trend, right, from the upper left to the lower right. But what's really interesting is that this little horizontal black line here represents the 0% mark. Basically, there's negative yield in Europe, okay? Negative yield. So basically, if you want to buy European bonds, depending which ones, you have to pay the government a return, not the other way around, right? In the US, still, you buy a bond, you get a coupon, a yield. Not so in Europe. Extreme situation. I'm in Switzerland right now. This is the 50-year yield curve in Switzerland, okay? 50 years. So up to 50 years, this is the 0% line mark up here. All right, the yellow line. If you want to buy a 2-year bond in Switzerland, you pay 1% to the government, basically, right? So this is really, really, really interesting to note, and it doesn't make a lot of economic sense. A lot of people are making it. You can even just look at CNBC.com if that's a thing you do. Look at Jamie Dimon. That's my former boss at JP Morgan. He just said it last week or this week that it doesn't make sense to have negative yield, and it's a problem. It's an issue, right? So this is not good. Essentially, what we have is about 30% of global bonds, basically between 15 and 16 trillion, have negative yields. So all else being equal, if you're trying to buy a bond out there, about 16 trillion of them, dollar-denominated bonds, have negative. Well, it's not dollar. It's translated to currencies, have negative yield. And you can see how this has picked up over the recent years. So this is obviously a problem, right? So if you don't believe me, if you don't believe the charts, although I think you will in a minute when I really whip out the awesome charts, Alan Greenspan has. Do you guys remember Alan Greenspan? Anyone in here remember Alan? Big Al? Okay. He said, and you guys can go on CNBC.com here again if that's a thing you do, September 4th, 2019, he was on the tape, and I quote, "It's only a matter of time before negative rates spread to the United States." That's not me saying, that's just the words of Alan Greenspan, okay? And we say a matter of time, it's not gonna happen tomorrow. It's not gonna happen by November or December. This is gonna take some time, but it's a trend, right? So this is an issue. Now, the world population is aging. I don't know if you guys have noticed this. We have basically peak retirement rates in the United States in terms of the baby boomers. We have a large population of baby boomers that we deal with on the client side. I can tell you they are retiring at an accelerating rate. In Europe, we have an aging population. In Japan, we have an aging population. I have a lot of European clients, and guess what? They're also buying US bonds because of positive yields. All of this stuff is a structural headwind to bond yields. So all else being equal, bond yields in the United States should be going lower, which means bond prices would be going higher, all else being equal. Christine Lagarde, anyone know who Christine Lagarde is? Christine Lagarde is I think as of now, or maybe next week, she will be the IMF president. I think Mario Draghi, our Italian friend, ex-Goldman Sachs, he just I think had his last week at the ECB. He's going to be the new ECB chair. She's going to be the new ECB chair, and she said that she doesn't believe that the ECB has hit the lower effective rate, lower bound effect. So she still actually thinks that we could go lower. So she's the new ECB person coming in. She used to be at the IMF. Yeah. Now, all of this is, some of you guys might be rolling your eyes. Oh, I don't care about the IMF or ECB. Well, you should. Here's why. Here's a chart that I crafted for you guys where I pegged US bond yields versus European bond yields. And to take European bond yields, I used the German 10-year bond, okay, or the Bund is what it's called. And over here on the right-hand side, you can see, roughly speaking, again, I didn't make this chart yesterday, so these charts are off by a few basis points. It doesn't matter. The point is negative yield, negative 0.7 when I made this chart, versus US 10-year yield. I think it's like 1.8% right now in the state. So we have more than a 200 basis points, 2% difference in yield in Europe versus the United States. So all else being equal, and just considering one thing, don't you think some global investors are going to be looking to buying more US bonds? I tell you they are, because I deal with these people on a daily basis. Okay, so yield pressure in the United States is on heavily. Again, you're not going to necessarily see this on a day-over-day basis, but over time, through the lens of months and quarters and maybe a couple of years, this is a serious trend. And I personally, and I guess also Alan Greenspan agrees with me according to that quote, it's very difficult to see this end. Even a lot of bank presidents, you can just kind of peruse through your latest financial news, are kind of in that same yield. One other thing I want to leave you with before we look at some awesome charts here. If the United States is genuinely a safe haven, then why are bond yields the highest out of the developed world? So I want you to really think about this. I have one of the greatest investors one of the greatest analysts that I know, got this in my head a couple of months ago as we had lunch, and he told me, he's like, it doesn't make sense. Just again, all else being equal, why, if it was generally the safe haven, wouldn't you think that that's where bond yields are the lowest, right? So it's all doesn't really make a whole lot of sense if you look at it that way. You guys still with me? Yes, no, maybe? Some of you guys are asleep. Get some more coffee, because now we're now getting to the awesome charts. We do, by the way, have a flat to inverted yield curve in the United States, which basically means that shorter dated bonds are yielding more than some of the middle part of the curve. Not a whole lot of not very good going forward, right? Basically, and yeah. So that's what's going on here. So here is just a chart, okay? And you're not asking you to agree with me, I'm just showing you a chart. This is the long-term chart, going back to the 80s, basically the mid to late 80s, all right? And you guys can tell me, but what is the tendency of the 30-year bond yield? Again, this is not price, this is yield of the 30-year. It's lower. I think anyone can see that. And by the way, we're kind of hanging over a cliff right now. Just FYI. How about the 10-year? Right, we're going to try to go down the yield curve. 10-year, same story. This is not data from just that goes back a couple of days or a couple of weeks. Well, this goes back to the 80s. In fact, it goes back even further. Again, the tendency is pretty clear. A series of lower lows and a series of lower highs. Right. So that's what we're after here, and I think the trend is probably going to go lower. How about the 2-year yield? Can you guys see that? Well, the yield here is pretty clear as well, and it's probably going to go lower. So basically, what I'm trying to show you, if the trend continues in the 10-year yield, if it continues, and I think it does, you could easily see 0% rates to maybe even negative. And again, I'm not trying to fear monger. I'm just trying to show you what the charts is telling us, right? If this long-term trend continues, then you could see 0 to even negative yields. As you guys can see, the lower bound of this range is negative to 0. On the 2-year front, it gets really crazy. This is the short end of the yield curve. Here, if this trend continues, then you could see certainly 0% yield on the 2-year, but in an extreme case, negative 4%. Now, again, I want to be clear, that's not my base case. And I'm not here to fear monger. I want to be very clear, but I'm just trying to show you what the charts are kind of hinting towards. Make sense? Okay, and again, to be clear, I don't need you to agree with me. I'm just trying to show you stuff. So here's something really interesting as well. This is a bit of a sidestep, and now we're going to get into the trade here in a second. The blue line is the 10-year yield on the US Treasury note that I just showed you here several times. And you can see it's lower. What's really interesting though, you see the red dots? That is the yield, the interest rate, I should say, that people are getting charged on credit card plans. What does this tell you that credit card companies are thinking about the consumer going forward? Right? Food for thought. So 30% of global sovereign bonds have negative yield. In my opinion, this pushes people into riskier assets, longer duration, and ultimately, basically, into less liquid instruments. And ultimately, I think it's going to be a problem for high yield bonds as well as other risk assets as well. Perversely enough, equities, the stock market, could actually technically hold up relatively well. At least the dividend growth payers, like the dividend aristocrats, because people are forced to buy certain equities because of their dividend, because they're not getting any dividend anymore or any yield anymore, and less yield in the bond market. So that desperate search for yield is a problem, and I see it every day. People are concerned. So ultimately, it actually leads for a lot more financial engineering, and we're seeing this take place between levered ETFs to all sorts of products out there. I can tell you have a lot of people in the investment banking and private banking world, and they're coming up with a lot more esoteric stuff for their clients. Long story short, I think it's time to protect yourself, because if the economy continues to slow more, then what's going to happen that the corporate bond buyers will leave, and the stock buyback programs will stop, or at least slow down. And the risk of all of this is that the corporate bonds and the stock market start to deteriorate just as baby boomers hit peak retirement rate. That's not very good. In addition to that, think about pension funds. Pension funds are heavily invested in bonds. If their return assumptions is, I don't know, 5 or maybe even 10% per year on your pension, but bond yields, the US Treasury is close to 1 to maybe 0% at some point, what do you think that means for your return on your pension? It's not going to happen, right? And this is not a new, it's not a new thing. This has been known for some time, but it's really now starting to come to a head, right? So this is a problem, and I think people need to protect themselves with this, about this problem. And so we're going to look at this here in a minute. In the interest of time, I'm going to skip one quick slide, because I want to go through and actually get to how do we actually profit from this? What the hell? How do you make money with the surge? Tell me. Okay, here's the thing. So again, we're basically looking at US interest rates going lower. That's my base case. I'm not saying they have to go negative, but I think they will go lower. There is an inverse relationship between bonds and bond yield, right? So bond price goes up, bond yield goes lower. If bond yields go lower, if the yield of 10-year treasuries, 2-year treasuries goes lower, then bond prices go higher. So the very simple idea, which might be a bit boring to some of you, but I can tell you it's very much intact, buy US Treasuries, right? A lot of you guys are yawning and saying, oh my God, I could have just, gone play golf. I didn't need to hear all this, because, well, it's just an idea. There's other ways of doing it, right? But you could just buy treasuries, and I think you could buy short-term treasuries. One could even buy middle of the curve or the long bonds. If yields go lower, then all these things should technically go higher. Again, the yield, the trend here is your friend. That's our macro call, that the trend is lower. 2-year treasury yield, I think, could easily go to 0, and potentially, it's not my base case, but potentially could go lower. Idea number 2, has anyone here ever looked at an ETF? Does anyone trade ETFs? You could just buy an ETF. You could just buy an ETF like the SHY ETF. This represents the short end of the yield curve, or shorter end of the yield curve. One could buy TLT, another good option. I see some people typing that in. TLT represents the 20 to 30 year maturity of the yield curve, right? So technically speaking, all these things are viable. If you don't want to buy treasuries, you could just buy an ETF. Right? Technically speaking, by the way, the charts look pretty good. This happens to be the chart of the SHY ETF. Again, this is not yesterday's chart, but bigger picture, you can see that's very much intact. Thirdly, what you could do, and just I stress the numbers you're about to see. These numbers here are just hypothetical, so I don't want you to quote me on these price points here. This is just for perspective, but you could just buy calls, right, or a call spread on something like the SHY ETF or the TLT ETF. You could do that. For example, you could buy a June 2020 call, right? An at the money strike call. You probably wouldn't, you don't want to hold these very long. You want to roll them every 3 months or so, but you could do that. It's a trend following trade. It's not a day trade. It's not something you have to sit up in bed at night. It's a trend following trade. And if you guys can see the point I'm trying to make, again, I'm not asking you to agree with me, just showing you some data, then this kind of makes sense, right? So you can lever these bets. You can buy a call in the SHY. You can buy a call on TLT. Just again, if you do that, not a recommendation, but an idea. I think one could buy those a little bit further out. Again, maybe June or summer of 2020, at least to start off with. So to me, I'm personally focused more on the short end of the yield curve. So I would be more of a buyer of the SHY ETF, i.e. shorter term bonds as opposed to longer term. But again, if yields go lower across the curve, then all of this should work. Why do all this? It's not only there's a lot of money to be made, but it's also a portfolio hedge and a retirement hedge. And again, it's a trend following trade of the pros. And by the way, it's significantly less volatile than stocks. But wait, there is more, okay? Now, idea number 4, and in full disclosure, I have this trade on already. I've had it on for a couple months already. This is the trade that a lot of my friends in the hedge fund world, a lot of individual investors I've talked to, they have this trade on. And it's very simple. They are long what's called a euro-dollar future. Now, if you've never traded futures, I'm not forcing you to trade futures. I'm simply sharing this is the trade these people have on. What is it? Basically, it's a potential to 10x your return. You can make money buying treasuries. You can make money buying an ETF on bonds, but this is a 10x potential. It's an interest rate future. Let me be very clear. Euro-dollar futures has nothing to do with the interest rate. It has nothing to do with the currency, the euro-dollar currency. This is an interest rate product, okay? It basically it mimics bond prices, right? The great thing about this is there's no time decay. It's a smaller investment because when you trade futures, you only put up a margin and you don't have to buy the whole upfront investment like you do with an ETF or treasuries. And it's an amazing trend following opportunity, okay? Now, let's talk a little bit more. This is probably the most important chart that I can show you. This is an explosive pattern to watch. This is a long-term chart, and long-term in this case means going back about, back to the late 90s. And you can see what the euro-dollar futures have done over time, right? Look at these 2 inflection points here. Look at this inflection point here in early 2001 or so. Look at this inflection point here as we headed into 2008. Who can tell me what happened at each one of those situations? What happened in each one of those situations is that the economy was starting to slow down. We weren't yet into recession. So if we have another situation here where the economy is slowing down meaningfully enough, these euro-dollar futures, think of them like bonds. They act like bonds, right? Bonds will go higher. Euro-dollar futures go higher if interest rates go lower. I think we're once again at an inflection point like we were here in 2008, like we were here in 2001. Okay, now again, I'm not calling for a meltdown in global economic situations, and I'm not calling for this to go to 103. I'm just thinking that interest rates could go towards 0, right? If that happens, this will go towards 100, and that's a ton of money to be made. Now, here's what the ROI potential looks like on something like this. If you invested, hypothetically speaking, $360, you could stand to make $3,600. That's a 10x return. If you invested $500, you could make $5,000, right? If you invested $10,000, you could make $100,000. If interest rates start going towards 0, not to 0 necessarily, or even not even to negative, right? But this is really the trade that we're in, that a lot of my clients in the hedge fund and family officer community are in, and this is what I think makes a lot of sense. Now, to be very clear, you don't have to trade euro-dollar futures in order to make money with this trade. You can just easily buy bonds. You can buy an ETF. You can buy calls on one of those ETFs, right? Now, if you're interested, guys, what you can do is you can join us and do this trade with me and all my clients over the next 12 months together. Now, what you're going to get is you're going to get the monthly decade trade setup report. That's basically these slides here, and I update them every month. That would be $497. The ongoing every month with intra-month updates, ongoing live webinars are $997. The total value of this package is $1,494. If you're interested to join us, if you're one of the next 100 subscribers, you can join this. You can get it right now at 86% off, okay, for $197, one-time payment. This is not an ongoing payment. It's not a monthly subscription. It's not an annual fee. It's one time. We'll do this together for the next 12 months. How does it work? First of all, as soon as you sign up, and you have to be one of the first 100 people here, you can go to www.steadytradersecrets.com/trend, and I believe, yes, Silas has already typed it into the chat box, so thank you for that. What's going to happen is as soon as you sign up, you're going to get an email with a login to the website. Here is what it looks like. You'll be able to get to the decade trend, the reports, which is, again, basically these slides, but we update them every single month. Also, you'll get access to the monthly webinars. We do monthly webinars to update you on the trade, and we update you intra-month with a video as well. So we do this for the next 12 months together. This is a 12-month thing. So again, you only pay once, $197, that's it. For the next 12 months, we'll do this trade together. It doesn't matter whether you want to do this trade using buying treasuries. It doesn't matter whether you want to do this trade buying an ETF like TLT or SHY, or whether you want to buy options on SHY or TLT, or whether you want to do it with Eurodollar futures. We will do it together. I will explain each one of these trades and update you every single month in a live webinar and an intra-month video update. Does that make sense? So why is this important? Why is it important to update you guys on a monthly basis and even intra-month? Because this is a trend following trade. This is not the kind of trade you have to be hectically going in and out of 9 times a day. This is about evaluating economic data as it unfolds. So if this makes sense to you guys, I'm not asking you to agree with me, but if it makes sense to you, I would urge you to enjoy this right now, to join us right now here. Again, it's just $197 for the next 100 people, and we'll do this together. The symbol for Eurodollar futures is, it depends on your platform, but it starts with a GE, /GE. It really depends on your platform. Okay. Was this helpful, guys? Give me a quick yes if this was helpful to you guys. Yeah? Good. Go ahead and join us. It's just $197. I don't think this is an opportunity anyone can miss. Even if you don't do the trade, I would urge you to join this, because we're going to update you guys on the global situation every single week, every single month, twice, right? And if something happens of importance, I will update you guys as well. This is what I do. The people I talk to have this trade on. Doesn't make me a better person to talk to these people. It makes you someone who does this for a living and has done this for 20 years. I have done this trade once before in my life. I did it going into the 2008, 2009 downturn. I made a ton of money for our clients. We have it on right now, and we're excited to be able to share this with you guys now, really for the first time. I've never actually shared it with anyone here going forward. So again, folks, I look forward to having you guys on board. Then, by the way, the next monthly webinar will be November 1st, on Friday, November 1st at 11 a.m. Eastern, 8 a.m. Pacific. These things are always recorded, so you don't have to worry about missing anything. Always recorded, and yeah, that is. Yeah, this is 1 year. We only do this for 1 year, right? So we're only doing this for 1 year. We're going to evaluate, maybe in a year, we'll do it another year. But for right now, we're doing it for 1 year, right? So for the next 12 months, it's $197. It's not, the plan isn't really to continue it, but we might if there are enough people want to. So we might be able to do that. Cool. Well, listen, guys, I think my time is pretty much up here. I'm going to pass this back to my good friend Silas. I hope you guys all enjoyed this. I wish you a great rest of the weekend, and I look forward to seeing you guys on board. Take care.